In January 2026, the International Monetary Fund released an update to its World Economic Outlook that reads less like a victory lap and more like a diagnosis. On the surface, the global economy appears resilient. Growth has not collapsed, financial markets have not seized up, and inflation is no longer spiraling out of control. But beneath that surface stability lies a system under structural strain. The IMF describes today's world economy as balanced on a narrow ridge, with powerful forces pulling in opposite directions. This is not a story of crisis avoided. It is a story of tension postponed. The headline number sets the tone. Global growth in 2026 is projected at 3%, marginally higher than expected just a few months earlier. In a vacuum, that sounds reassuring, yet context matters. This level of growth is well below the pre-pandemic average and masks widening divergences across regions. The global economy is not moving forward together. It is fragmenting, with some regions accelerating and others slowly grinding down. The United States sits at one end of this divergence. Growth there is holding up better than most advanced economies, supported by a powerful wave of investment in technology, particularly artificial intelligence, and by expansionary fiscal policy. The 2025 One Big Beautiful Bill Act injected significant government spending into infrastructure, defense, and technology. That stimulus is still flowing through the system, but it comes at a cost. The IMF notes that U.S. growth is increasingly financed by foreign capital, deepening external imbalances. In other words, America's resilience depends heavily on the rest of the world's willingness to fund it. Europe occupies the opposite end of the spectrum. Growth in the euro area remains subdued, constrained by structural rigidities and persistently high energy costs. Even as inflation has eased from its peak, households and firms continue to face elevated living and production expenses. Germany, the region's traditional engine, is growing slowly, while Japan struggles with weak domestic demand and demographic headwinds. These economies are not in recession, but they are not thriving either. They are stuck in a momentum equilibrium that is difficult to escape. Asia presents a more complex picture. India remains one of the fastest growing major economies, driven by demographics, domestic investment, and its role in reconfigured global supply chains. China, meanwhile, continues to contribute significantly to global growth, but its model is shifting in uncomfortable ways. With domestic consumption weak and the property sector still under pressure, growth is increasingly export-dependent. That reliance creates vulnerabilities, especially in a world where trade is becoming more politicized and protectionist. This regional divergence is not accidental. It reflects a deeper transformation in the structure of the global economy. Growth today is no longer the result of synchronized recovery. Instead, it is the outcome of offsetting forces. Protectionist trade policies and geopolitical fragmentation act as brakes, while rapid technological investment and selective fiscal expansion act as accelerators. The global system is moving forward, but only because some parts are compensating for the slowdown in others. Inflation adds another layer of complexity. Headline inflation, which includes volatile food and energy prices, is gradually declining. The IMF expects global headline inflation to fall from 4.1% in 2025 to 3.8% in 2026. Central banks would normally welcome that trend. But the real concern lies beneath it, in core inflation. Core inflation strips out food and energy to capture underlying price pressures, and here the progress has been stubbornly slow. The persistence of core inflation is one of the central paradoxes of the current cycle. After years of aggressive monetary tightening, many expected labor markets to loosen and wage pressures to fade. That has not happened. In many advanced economies, labor markets remain tight, particularly for skilled workers. Service sectors, which are labor-intensive by nature, continue to face rising costs. When wages rise, service prices follow, creating what economists call a wage price loop. This loop is not driven by excess demand in the traditional sense. It is driven by structural shortages of labor and skills. Housing costs amplify this effect. In countries like the United States, the concept of owner's equivalent rent plays a large role in measured inflation. This metric reflects what homeowners would theoretically pay to rent their own homes. It adjusts slowly, with long lags. Even as housing markets cool, this component of inflation remains elevated, keeping core inflation above central bank targets. Europe faces a similar issue, with limited housing supply and high financing costs pushing rents higher. Trade policy has also re-entered the inflation story. Higher tariffs, particularly between major economic blocs, are filtering through supply chains. In the United States, effective tariff rates are now estimated to exceed 18% on imports from the rest of the world. These costs do not disappear. They accumulate at each stage of production and eventually reach consumers. Ironically, policies designed to protect domestic industries are undermining price stability, complicating the task of central banks. Taken together, these dynamics point to a form of inflation that is no longer purely cyclical. It is structural. It is embedded in demographics, housing markets, labor supply, and geopolitical strategy. That is why the IMF message in early 2026 is cautious rather than celebratory. The global economy has proven resilient, but that resilience is increasingly fragile. Growth persists, but its foundations are uneven. Inflation is receding, but its core remains sticky. This is the paradox at the heart of the current outlook, and it sets the stage for even deeper stresses ahead. Geopolitics, once treated as an external shock to economic models, has now become an internal variable. The IMF is explicit about this shift. Events in early 2026 demonstrate that political decisions are no longer occasional disturbances. They are continuous sources of economic pressure that shape inflation, trade, and investment flows in real time. One of the most striking examples is the situation in Venezuela. In January 2026, the United States launched a targeted military operation aimed at detaining President Nicolás Maduro. Markets reacted instantly. Energy traders priced in the risk of supply disruptions across the Caribbean and Latin America. In theory, a regime change in Venezuela could unlock long-term increases in oil production, easing global supply constraints. In practice, the short-term effect was the opposite. Risk premiums rose, uncertainty spiked, and volatility returned to energy markets. Yet oil prices did not surge. Brent crude is still projected to average around $56 per barrel in 2026, nearly 20% lower than the previous year. This apparent contradiction reveals something important. The global energy system is no longer driven by geopolitics alone. Expanding production outside OPEC, especially in the United States, combined with softer global demand, has created a buffer. Geopolitical shocks now raise volatility more than prices. That volatility, however, feeds directly into inflation expectations, corporate planning, and financial markets. A similar dynamic is unfolding in the North Atlantic. Tensions between the United States and Europe escalated after renewed pressure on Denmark regarding Greenland. Threats of tariffs on key European economies may be framed as national security measures, but their economic impact is clear. Higher tariffs raise input costs, disrupt supply chains, and weaken trust among allies. For firms operating across borders, uncertainty becomes a tax in itself. Investment decisions are delayed, inventories rise, and efficiency declines. These are slow, burning costs that rarely show up in headline data, but steadily erode productivity. Logistics offers another window into this new regime. After years of disruption from pandemics, wars, and trade disputes, global shipping is entering what analysts describe as calculated oversupply. A wave of new container ships ordered during the chaos of 2021 and 2022 is now entering service. Routes remain longer and less efficient due to security concerns, but capacity has grown faster than demand. As a result, container freight rates are falling sharply in 2026. This should be disinflationary, and to some extent it is. Lower shipping costs reduce goods price pressures, but the effect is uneven. Air freight tells a different story. The grounding of a significant portion of the global-wide body cargo fleet after a fatal accident has tightened capacity just as e-commerce and manufacturing continue to rely on fast delivery. Localized supply constraints coexist with global oversupply, reinforcing the sense that the system is no longer smoothly integrated. All of this feeds into what the IMF increasingly refers to as structural inflation. Unlike cyclical inflation, which rises and falls with demand, structural inflation persists because it is rooted in long-term changes. Two forces dominate this landscape: demographics and the green transition. In advanced economies, populations are aging. Fewer workers are entering the labor force, while more are retiring. This shift reduces potential output and increases workers' bargaining power. Wages rise, not because the economy is overheating, but because labor is scarce. Even modest growth can generate wage pressure under these conditions. Without reforms to migration, labor participation, or productivity, this dynamic becomes self-reinforcing. Technology complicates the picture. Artificial intelligence is often presented as a solution to labor shortages, and over time it may be. In the short run, however, it creates a skills bottleneck. Demand for workers who can design, deploy, and manage AI systems far exceeds supply. Wages for these roles rise rapidly, while workers without these skills face stagnation or displacement. This divergence produces what some economists call skills inflation, where pay increases are concentrated rather than broad-based. The aggregate effect is upward pressure on costs without a corresponding boost to mass consumption. The green transition introduces another structural layer. Decarbonizing the global economy requires massive investment in renewable energy, electric vehicles, and grid infrastructure. These investments depend on critical minerals such as lithium, cobalt, and nickel. Supply expansion in mining is slow, capital-intensive, and politically sensitive. Demand, by contrast, is rising quickly due to policy mandates and corporate commitments. The result is greenflation. Input costs for clean technologies rise, pushing up prices across supply chains. Carbon border taxes and emissions regulations add further costs, particularly in Europe. These policies are essential for long-term sustainability, but they impose short to medium-term inflationary pressures that monetary policy cannot easily offset. Central banks can raise interest rates, but they cannot mine more lithium or accelerate permitting processes. Climate itself is becoming an inflationary force. Extreme weather events disrupt agriculture, energy production, and transportation. Crop failures raise food prices, heat waves strain power grids, floods damage infrastructure. These are supply shocks that recur with increasing frequency. The IMF now treats climate-related disruptions as part of the baseline, not as tail risks. Against this backdrop, the condition of the global middle class becomes critical. Middle-income households are the backbone of consumption-driven economies. Their spending patterns determine whether growth is sustainable or fragile. The IMF analysis suggests that this group is approaching its limits. In the United States, consumer debt continues to rise, but at a slower pace. Credit card balances are projected to exceed $1 trillion in 2026. On paper, delinquency rates remain manageable. Beneath the surface, however, a growing share of middle-income households report living paycheck to paycheck. Fixed costs such as housing, insurance, healthcare, and education have reset at higher levels. Discretionary spending is being squeezed. This creates what analysts call the resilience paradox. Consumption remains stable, but only because households are reallocating spending and drawing on credit. Savings accumulated during the pandemic have largely been exhausted. The buffer is gone. When shocks arrive, there is less room to absorb them. Europe faces a similar squeeze, compounded by tighter credit conditions. Banks have become more cautious in consumer lending. Wage growth has not fully caught up with past inflation, leaving real incomes under pressure. In China, the story is different but equally concerning. There, the middle class is grappling with declining household wealth due to falling property prices. With most savings tied up in real estate, the negative wealth effect has dampened consumption and reinforced precautionary saving. These trends point to a common conclusion. The global economy in 2026 is not fragile in the traditional sense, but it is brittle. It can withstand small shocks, but large or sustained disruptions risk triggering nonlinear responses. Structural inflation, geopolitical fragmentation, and middle-class strain are interacting in ways that standard policy tools struggle to address. This is the world the IMF is describing, not a crisis, but a transition, not collapse, but constraint. The question is no longer whether the system will change. It already has. The question is whether policymakers, businesses, and households can adapt fast enough to a new normal defined by limits rather than abundance. Adaptation is the central theme of the IMF outlook, even if the word itself appears less frequently than growth or inflation. The underlying message is that the economic rules of the previous decade no longer apply. The era of cheap money, abundant labor, frictionless trade, and low volatility has ended. What replaces it is not a single new regime, but a set of constraints that interact in uncomfortable ways. For policymakers, this creates a coordination problem. Monetary policy has been asked to do too much. Central banks raised interest rates aggressively to contain inflation, and in doing so, they succeeded in preventing an outright loss of price stability. But the remaining inflation is no longer driven primarily by excess demand. It is driven by supply-side rigidities, demographics, housing shortages, and geopolitics. Higher rates can suppress demand, but they cannot fix these structural bottlenecks. When rates stay high for too long, they risk damaging investment and financial stability without delivering proportional disinflation. Fiscal policy, meanwhile, is pulling in different directions. In the United States, expansionary fiscal measures continue even as monetary policy remains tight. This policy mix supports growth in the short term, but widens deficits and external imbalances. In Europe, fiscal rules and political constraints limit governments' ability to respond forcefully, leaving monetary policy to carry more of the burden. In emerging markets, high global interest rates and a strong dollar constrain fiscal space, forcing painful trade-offs between growth, stability, and social spending. The IMF argues that better coordination between fiscal and monetary authorities is essential, but this is easier said than done. Political incentives often favor short-term support over long-term balance. Governments face elections. Central banks face credibility tests. The result is a stop-and-go policy environment that increases uncertainty for firms and households alike. Businesses are responding by rethinking efficiency. For decades, global supply chains were optimized for cost minimization. Production was concentrated where labor was cheapest, inventories were kept lean, and resilience was an afterthought. That model is breaking down. Firms now prioritize redundancy, geographic diversification, and security of supply. These choices raise costs, but they reduce vulnerability. In aggregate, this shift contributes to higher prices and lower productivity growth, at least during the transition. Investment patterns reflect this change. Capital is flowing into semiconductors, energy infrastructure, defense, and AI. These sectors promise strategic advantage rather than immediate consumer benefit. They support growth in certain regions and industries while leaving others behind. The uneven distribution of investment reinforces regional divergence and income inequality. For households, especially the middle class, adaptation takes a more personal form. Spending patterns are changing. Experiences, subscriptions, and discretionary services are being reassessed. Value matters more than novelty. Financial caution is becoming a norm rather than a temporary response. This is not a collapse in demand, but it is a recalibration. Consumption growth is likely to be slower and more selective than in the past. This behavioral shift has macroeconomic consequences. When households prioritize security over expansion, multipliers weaken, stimulus becomes less effective. The economy becomes less responsive to traditional levers. This reinforces the sense of stagnation, even when headline growth remains positive. One of the IMF more subtle warnings concerns asset markets, particularly those tied to artificial intelligence. The rapid appreciation of AI-related equities has generated significant wealth for a small segment of the population. This concentration amplifies inequality and increases systemic risk. If valuations correct sharply, the negative wealth effect could spill over into broader consumption and investment, especially in economies where financial markets play a central role in household balance sheets. This is not a prediction of collapse, but it is a reminder that financial exuberance can coexist with underlying fragility. The global economy has avoided recession, but it has not resolved its contradictions. Growth persists alongside strain. Innovation advances alongside insecurity. Stability is maintained, but at a higher cost. The IMF outlook for 2026 should therefore be read less as a forecast and more as a framework. It describes an economy in transition from one set of assumptions to another. The old assumption was that shocks were temporary and systems would revert to equilibrium. The new reality is that shocks are persistent and equilibrium itself is shifting. In this world, resilience does not mean returning to the past. It means functioning under constraint. It means accepting higher inflation volatility, slower trend growth, and more frequent geopolitical disruptions as features rather than bugs. It means redesigning institutions, policies, and expectations to fit a less forgiving environment. The painful part of this adjustment is unavoidable. Structural reforms take time. Demographic trends cannot be reversed quickly. Climate adaptation and mitigation require upfront costs. Trade fragmentation reduces efficiency before new networks mature. During this period, frustration will grow. Political pressure will intensify. Simple narratives will gain traction. Yet there is also opportunity embedded in this transition. Productivity gains from AI, if broadly diffused, could offset labor shortages. Green investment, if coordinated and scaled, could reduce long-term energy volatility. More resilient supply chains could prevent the worst outcomes of future shocks. None of these outcomes are guaranteed, but they are possible. The IMF core message is that endurance alone is not enough. The global economy has proven it can absorb shocks, but absorption is not adaptation. Without deliberate structural change, resilience becomes a holding pattern rather than a path forward. As 2026 unfolds, the defining challenge will not be avoiding crisis, but managing constraint. Policymakers will need to choose which pressures to relieve and which to endure. Businesses will need to decide where to invest and where to retreat. Households will need to balance caution with participation in a changing economy. This is the new normal the IMF is pointing toward. Not collapse, not recovery, but recalibration. A world where stability is maintained through constant adjustment, and where the margin for error is thinner than it has been in decades. To understand where this recalibration ultimately leads, it helps to step back and examine the constraints as a system rather than as isolated problems. The IMF January 2026 outlook implicitly argues that today's challenges reinforce one another. Inflation persistence limits policy flexibility. Policy uncertainty weakens investment. Weak investment constrains productivity. Low productivity makes inflation harder to tame. This feedback loop is the defining macroeconomic mechanism of the current era. Consider productivity first. For most of the past decade, advanced economies experienced disappointing productivity growth despite rapid technological change. Cheap capital kept inefficient firms alive, while globalization allowed companies to rely on external labor and inputs rather than invest in domestic efficiency. That era is ending. Higher interest rates are forcing capital discipline. Fragmented trade is reducing easy arbitrage. In theory, this should raise productivity by reallocating resources toward more efficient uses. In practice, the transition is messy. Productivity and enhancing investments take time to deliver returns. In the interim, higher financing costs discourage marginal projects, especially in sectors outside technology and energy. Small and medium-sized enterprises, which employ a large share of the workforce, face the tightest constraints. The risk is a two-speed productivity outcome. Frontier firms surge ahead, while the rest stagnate or fall behind. This widens income and regional inequality, reinforcing political tension. Demographics intensify the challenge. Aging societies are not just losing workers, they are losing risk tolerance. Older populations tend to save more and spend less, reducing aggregate demand. They also place greater pressure on public finances through pensions and health care. Financing these obligations becomes harder when growth is slower, and debt levels are already elevated. Governments face a trilemma: raise taxes, cut benefits, or increase borrowing. Each option carries political and economic costs. Emerging markets confront a different but related dilemma. Many entered the 2020s with improved policy frameworks and stronger institutions. Yet higher global interest rates have reversed capital flows and strengthened the dollar. Servicing dollar-denominated debt has become more expensive. Fiscal space is limited, just as investment needs are rising. These economies must navigate between maintaining credibility with investors and supporting domestic growth and social stability. The green transition compounds fiscal strain everywhere. Climate commitments require massive upfront spending on infrastructure, subsidies, and adaptation. These investments promise long-term benefits, but their short-term payoff is uneven. Countries that can finance them cheaply and manage them efficiently gain an advantage. Those that cannot risk falling behind technologically and competitively. The global economy thus faces the prospect of climate-driven divergence layered on top of existing inequalities. All of this feeds back into inflation expectations. When households and firms believe that costs will remain volatile, they behave differently. Workers push for higher wages to protect purchasing power. Firms raise prices preemptively to protect margins. Investors demand higher returns to compensate for uncertainty. Inflation becomes embedded not because demand is excessive, but because trust in stability erodes. This is why the IMF emphasizes credibility and communication as policy tools. Central banks must convince markets that inflation will be contained over the medium term, even if it fluctuates in the short term. Governments must articulate clear fiscal strategies that balance support with sustainability. Mixed signals amplify uncertainty and raise the cost of adjustment. Yet credibility alone cannot substitute for reform. Structural inflation requires structural responses. Housing supply constraints need zoning and permitting reform. Labor shortages require immigration policy childcare support, and retraining programs. Greenflation requires coordinated investment in supply chains for critical minerals and energy storage. Fragmented trade requires new frameworks for cooperation that acknowledge security concerns without abandoning efficiency altogether. These reforms are politically difficult because their benefits are diffuse and delayed, while their costs are immediate and concentrated. Temptation is to deter them and rely on childcare shore or support, or term fixes, that programmemptation has defined much of the past decade. The IMF outlook suggests that it is no longer viable. From a historical perspective, the current moment resembles other periods of global transition. The 1970s combined inflation, energy shocks, and geopolitical realignment. The 1990s combined technological change with globalization and institutional reform. Each period involved pain, adjustment, and eventual reconfiguration. The difference today is that multiple transitions are occurring simultaneously: technological, demographic, climatic, and geopolitical. This simultaneity reduces the margin for error. Policymakers cannot sequence reforms neatly. Trade-offs are unavoidable. Supporting growth may mean tolerating higher inflation. Containing inflation may mean accepting slower growth. Investing in resilience may mean sacrificing short-term efficiency. There is no policy mix that delivers all objectives at once. For investors, this environment demands a different mindset. The assumption of ever lower interest rates and expanding valuations is gone. Returns are likely to be more volatile and more dependent on fundamentals. Sectors aligned with structural priorities, such as energy transition and digital infrastructure, may outperform, but they also carry policy risk. Diversification, once achieved through global exposure, now requires careful consideration of geopolitical alignment and regulatory regimes. For workers, the implications are equally profound. Skills matter more than credentials. Adaptability matters more than tenure. Lifelong learning shifts from slogan to necessity. Those who can complement technology rather than compete with it gain bargaining power. Those who cannot face insecurity, even in tight labor markets. Social safety nets and retraining systems become not just welfare tools, but macroeconomic stabilizers. For the middle class, the recalibration is psychological as much as financial. Expectations formed in an era of cheap credit and rising asset prices are being revised. Stability is redefined. Progress is measured less by consumption growth and more by resilience to shocks. This shift may ultimately support more sustainable economic behavior, but the transition is uncomfortable. As the IMF January 2026 outlook makes clear, the global economy is not on the brink of collapse. It is, however, at an inflection point. The old equilibrium is gone, and the new one is not yet fully formed. Resilience has bought time, but time must be used wisely. The final question is whether global coordination can keep pace with global change. The forces reshaping the economy do not respect borders. Yet political responses remain largely national. Bridging that gap is the central challenge of the coming years. Whether the world manages a smooth recalibration or stumbles into crisis will depend less on the shocks themselves than on how effectively societies adapt to the constraints they now face. The IMF January 2026 outlook ultimately forces a reframing of what economic success means in the years ahead. For much of the post-Cold War era, success was defined by acceleration, faster growth, faster trade, faster capital flows. Volatility was treated as an anomaly, something to be smoothed away with better policy and deeper integration. That mental model no longer fits the world we are in. What defines 2026 is not speed, but friction. Friction in labor markets, where skills do not match demand. Friction in trade, where security concerns override efficiency. Friction in energy systems, where legacy infrastructure collides with climate imperatives. These frictions slow growth, but they also reveal the true constraints of the system. The IMF message is that ignoring these constraints does not restore the old model. It amplifies instability. The IMF January 2026 outlook ultimately forces a reframing of what economic success means in the years ahead. For years, policymakers acted as if inflation control, growth support, and financial stability could be achieved simultaneously. The current environment has shattered that illusion. Every policy choice now has visible costs. Cutting inflation through aggressive tightening risks undermining investment and debt sustainability. Supporting growth through fiscal expansion risks entrenching inflation and widening external imbalances. Protecting strategic industries raises resilience but reduces efficiency. This forces a more honest conversation about priorities. In a world of constraints, what should be protected and what can be sacrificed? The IMF does not provide a single answer, but it does suggest that pretending the trade-offs do not exist is the most dangerous option. The report also reframes the role of risk. In the past, the middle class is long been treated as a passive beneficiary of growth. Shocks arrived, policies responded, equilibrium returned. In 2026, risk is increasingly endogenous. Policy decisions create feedback loops that shape future outcomes. Trade restrictions invite retaliation. Fiscal expansion invites tighter monetary conditions. Delayed reform increases the eventual cost of adjustment. This endogeneity of risk changes how resilience should be understood. Resilience is no longer about absorbing shocks and bouncing back. It is about reducing exposure to self-reinforcing dynamics. That means designing policies that dampen feedback loops rather than intensify them. It means accepting slower growth today to avoid sharper corrections tomorrow. For central banks, this implies a shift in communication. Precision and humility matter more than confidence theater. Acknowledging uncertainty can strengthen credibility if it is paired with a clear framework for decision making. The goal is not to promise stable outcomes, but to demonstrate consistent reasoning under changing conditions. For governments, the implication is even starker. Structural reform is no longer optional, but it is politically hazardous. Housing reform threatens incumbents. Immigration reform provokes backlash. Pension reform angers voters. Yet postponing these decisions does not make them easier. It simply shifts the burden forward, often onto younger generations with less political power. The IMF analysis of the middle class is especially revealing in this context. The middle class has long been treated as a passive beneficiary of growth. In 2026, it is a constraint. When middle-income households feel insecure, they pull back. They save more, spend less, and resist change. This behavior is rational at the individual level, but destabilizing at the macro level. It weakens demand, reduces tolerance for reform, and fuels political polarization. Restoring middle-class confidence therefore becomes a macroeconomic objective, not just a social one. That does not mean returning to easy credit and asset inflation. It means addressing the sources of insecurity directly: housing affordability, healthcare costs, job transitions, and income volatility. These are not traditionally seen as macroeconomic tools, but in a constrained world, they function as stabilizers. Technology sits at the center of this tension. Artificial intelligence promises productivity gains, but it also accelerates disruption. If its benefits accrue narrowly, it will intensify inequality and resistance. If they are diffused through education, training, and complementary investment, they could ease labor constraints and support growth. The difference lies not in the technology itself, but in institutional choices around it. The same is true for the green transition. Climate policy can be inflationary and divisive in the short run, or stabilizing in growth, enhancing in the long run. Coordination matters, sequencing matters. Ignoring distributional effects is a recipe for backlash that ultimately undermines the transition itself. The IMF does not claim that the world will get these choices right. Its role is diagnostic, not prescriptive, but the diagnosis is clear. The global economy is entering a phase where resilience without reform leads to stagnation, and reform without resilience leads to instability. The challenge is to pursue both at once. Looking ahead, the defining risk is not a single shock, but cumulative fatigue, policy fatigue, household fatigue, institutional fatigue. When systems operate near their limits for too long, even modest disturbances can have outsized effects. This is why the IMF repeatedly emphasizes margins of safety, fiscal buffers, financial regulation, social cohesion. These buffers do not boost growth in good times, but they prevent collapse in bad ones. In that sense, the January 2026 outlook is less a forecast than a warning label. It tells us that the world has changed and that old assumptions are liabilities. Stability now requires constant adjustment. Growth now requires acceptance of limits. Prosperity now depends as much on distribution and trust as on output and efficiency. The paradox the IMF describes is real. The global economy is resilient, but that resilience is costly. It is purchased with higher inflation volatility, greater inequality, and persistent uncertainty. Whether this paradox resolves into a new equilibrium or fractures into crisis will depend on how societies respond to constraint. The choice is not between optimism and pessimism. It is between adaptation and denial. The IMF message is that time remains, but it is no longer abundant. The world of 2026 is not broken, but it is demanding. Those who recognize that demand and act accordingly will shape the next phase of the global economy. Those who do not will discover that resilience on its own is not a strategy.